Hello and welcome to Switzer Investing Insights, brought to you by nabtrade. And with interest rates on the slide, the question is, what will happen to dividends and their yields in 2020? Will they go lower? Paul?
Look, I don't want us to be a purveyor of bad news, but unfortunately dividend yields are falling, and I think as investors we need to understand that and appreciate that just like interest rates have come down, so are dividend yields going to come down as well. Let's just go through some of the factors, and there's some are a little bit one-off, but there are really four factors that are driving it. First of all, last financial year...
You're talking about how good last financial year was.
Yeah, last financial year was an absolute crack of a dividends. Look, we had a lot of the major companies pay special dividends. We had all the big miners return a lot of capital, which really helped things. But we also had a major change, or a proposed major change to tax policy with Bill Shorten. And of course, one of the aspects of that was a lot of companies not only brought forward the payment of dividends, but also looked at the capacity to pay things like special dividends, increase off-market buybacks, and actually just to see if they could pay even more of an ordinary dividend, because they wanted to use up their franking credits before potentially some shareholders were going to be impacted. So we had an absolute cracker of a year in financial year 19. That won't continue for financial year 20. So it's really important to be cognizant of that. Secondly, we've had a huge growth in the stock market this year. We've had the market up by more than 20%. But the earnings growth for most of our companies has been a lot lower. In fact, at a market basis, it's more like in low single digits. Now, if the prices go up by 20%, but earnings only go up by 5%, then the capacity to actually pay higher dividends isn't there.
And this is really, even if they paid the same dollar amount, it's the percentage yield, isn't it, Paul? Because the price has gone up, but the ability to increase the actual dollar dividend is harder.
Yes, spot on, Peter. It's a bit of a function of mathematics. And when you look at a dividend yield, we are talking about the current price. If the price is a lot higher, the dividend is the same, the yield is actually lower. So just be wary of that we haven't had, the market has gone up for a lot of factors, mainly due to lower interest rates here in the US, but earnings growth hasn't matched, and so dividend yields have actually fallen.
That's a good point.
I think the other thing that sort of goes with that is a number of our major companies, particularly the banks, but also Telstra and a few others, have reduced their payout ratios. And that's the proportion of their profits they're actually paying out as a dividend. Companies don't distribute 100% of their profits. There has been concern for some of the analysts and the investors that some of these payout ratios weren't sustainable. They've been reduced, and so that's brought a reduction down in sort of dividend yields as well. And that's probably a trend that's going to continue. And the other thing is, again, a mathematical thing, but we have seen really a lot more weighting going into the so-called high growth, low dividend stocks. So companies like CSL and ResMed and the SEEKs and the REAs, which don't pay big dividends, they've become a lot more important in the overall index. And so if you're in sort of index tracking funds, they've got a lot more exposure to these companies that are paying lower dividends and less exposure to companies paying higher dividends.
So if someone was in an ETF that tracked the ASX 200 index and they got used to, say, a 4.5% yield, in 2020, you think it's going to be a bit lower?
It's going to be probably more like in the high threes than in the mid fours. So I think that's something we need to take into account.
Be mindful of, yep. So we've been talking about the way dividends have been shrinking, but just looking at dividends purely in isolation is not really the right way.
Yeah, but we know interest rates have also been falling, and of course dividends have this magic thing, well, a lot of dividends have this magic thing called franking. And
Love franking.
Which works for all shareholders at different tax rate, and of course we get to gross that up. So if we want to be able to compare say an interest return or a rental return we're getting from a property to a dividend, that's fully franked, we need to gross it up. So, and this table in front of you can see is the impact of that grossing up. So a 4% fully franked dividend yield is the same return in an after-tax situation as 5.7% that we might be getting from a property rental stream or an investment in a fixed interest or some other type of term security. Now, obviously different security characteristics. I'm not saying they're the same risk, but just in the income return, we need to adjust for the benefit of those franking credits.
And it does explain why dividend-paying stocks have gone for a big rise on the stock market.
And it does indeed, and the power of the franking credits. So this still is really, really important.
Okay. Let's go and look at the forecasted yields, the dividend yields for 2020 for the top 12 stocks.
Yeah, it's not all bad news here, Peter. And you can see now on the table in front of you a screen of the forecast dividend yields. This is based on current market price and forecast dividends. So they are forecasts, Peter. That we know that forecasts don't always come true, and also the relevant level of franking. And really, I suppose there's 3 points that stand out of this. One is we have a group of stocks, the so-called growth stocks, the companies like CSL with a yield of 1.1%, Wesfarmers 3.7%, even Woolworths at 2.8%, and arguably even Transurban 4.1%, which is only 7% franked. So we have sort of the low-yielding stocks. We've got sort of this residue of really the major banks, and some pretty exciting yields for stocks like Westpac and so forth. In the sixes, but some question marks around the sustainability.
Yeah, and these numbers on the yield are before franking too.
They're before franking, and these have already, in some cases, factored in a slightly further reduction in the actual dividend in cash sense. And then we've got sort of the major miners, and you've got to be a little bit careful with dividends for the major miners because they're so dependent on the commodity price. But it's not all bad news, but I'm just saying that if you look at it, take out the banks, you can see that generally the dividend yields on our other major stocks are a lot lower. And so we've been a little bit seduced, perhaps some investors, by what we've been getting in some of our bank stocks. And this is my point about just understanding that interest rates have come down, so have dividend yields.
Yeah, but I think the important point is that even though dividends are going to be reduced, particularly on an international comparison basis, they're still pretty attractive.
Yeah, they are, and of course, I think as investors, getting income is half the story, getting capital is the other part of the story, but it does provide in some cases a little bit of residue for that capital shock and a bit of a capital buffer potentially.
Yeah. So that's Switzer Investing Insights, brought to you by nabtrade. Thanks for joining us.